Welcome to the Banyan Edge Podcast. Here's your host, Charles Sizemore.
Welcome to the Banyan Edge Podcast, America's #1 source for smarter, safer, more profitable investing, where we aim to bring you the very best ideas from the very best minds in the business, completely filter-free. I am your host, Charles Sizemore. We got a fantastic show planned for you today. I'm going to start by bringing on my friends Mike Carr, Adam Odell, and Ian King to talk about the great silicone shakeout and how you can make potentially a lot of money from it. We're then going to go around the horn to discuss the stock that everyone loves, or maybe just loves to hate. Kind of hard to say. It's probably the most, it is the single most controversial stock of my lifetime. We're going to go around the horn and give a big emphatic thumbs up or thumbs down to Tesla, the electric vehicle leader headed by the enigmatic and perhaps crazy Elon Musk. We're then going to go a different direction here. We're going to take your questions, or not so much take, but answer your questions. We take that's something we get a lot of value from. We really want to know what's on your mind, and we really do our best to answer those questions. So with that, let's get into it. But before I do, I'll just say a quick word to keep the guys in suits happy. Do remember that these are our opinions. We're just four guys having a chat here. This should not be taken as specific investment advice. Do please read below to read our full disclaimer there. Now, on to the show. I'm going to talk about the great silicone shakeout. So we're in a bear market, and it's been particularly nasty for tech for well over a year now. Now, for a lot of investors, that's scary. That's, you see the market falling, you think this is bad for me, but that's not necessarily true. Some of the greatest fortunes in history have actually been made taking the other side of that. Now, I'm sure a lot of our viewers have seen the movie The Big Short, of course, that starred Brad Pitt, Christian Bale. Christian Bale in particular played a hedge fund manager that has since become a bit of a household name, Mike Burry. Mike Burry was actually a long-only trader for most of his career. He was a fantastic hedge fund manager in that small cap, micro cap space, but we don't know him because of that. He was a nobody. He was a very successful investor, but he was a nobody. No one knew who he was until The Big Short. Yeah, he made a fortune for himself and his investors betting against the mortgage market. Of course, John Paulson was essentially in on a very similar trade. He had the biggest short position or biggest short profit in history. Going to go further back, Jim Chanos made a name for himself shorting Enron, which was the biggest financial scandal in history up to that point. If you're going to go way back in time, you can go back to the days of Jesse Livermore, the legendary trader who some still considered the greatest trader of all time. He made $100 million or more in the 1929 crash. Translated into today's dollars, I believe that number is well in excess of $1 billion. So clearly, there is money to be made on the short side. And to talk about that, Mike, let's start with you. Like, you're a trader. You take both sides of the trade. How has short selling worked out for you?
Well, I want to go back with another example of 1992, George Soros. George Soros, still a household name, and he made a fortune. He made $1 billion in one day, betting against the Bank of England. And the legend is he broke the bank. Now, he started taking his position early that summer, 1992. And by the time it actually worked out for him, he had kept doubling down. He had over $10 billion in exposure to the British pound when it finally broke. So he made a 10% return in one day. If the pound had continued higher another week, Soros probably wouldn't have survived. He would have had a margin call. He would not be a leading political funder, and the world would be vastly different. So shorts have made history. And I think that's important to remember, that these short traders have an element of luck to them. You mentioned Mike Burry. Talk about a lucky guy. He was shadowing SBF when the whole thing collapsed. So he now has movie rights to SBF from the inside. He's not making money.
I think
from
that's
that
Michael
short.
Lewis, not Michael Burry.
Oh, I'm sorry. I thought it was
Michael
Burry.
Lewis wrote the book about Michael Burry, but yeah, I agree with that.
Okay.
Yeah.
So what a lucky guy. Could you imagine being in the compound as it was unfolding?
Yes.
So anyway, back to Soros in 1992. It takes a lot of money to go short. It takes a lot of risk to go short. Many short traders in 1996 saw that the NASDAQ was in a bubble. If you remember, Alan Greenspan, December 96 said it's irrationally exuberant. It gained 400%.
Mike, that's a great
crashed.
point. Everyone imagines everyone remembers the irrational exuberance comment, but they forget that Greenspan made that in 96. He didn't make it in 99 when it was about to break. It was actually several years before.
And there were an awful lot of people who lost money on the right side in the long run, but shorting requires, perfect timing. So rather than going short, I think there are ways to do it. Obviously, options. Put option, you're not going to end up having $10 billion in exposure like George Soros did. You're not going to end up with all of this risk exposure. So right now we're at the point where we're irrationally exuberant in some sectors, in particular tech. If we look at the last jobs report, tech's the only one that really suffered losses. We saw job gains everywhere except information technology and temporary services. And I think it's a pretty well-known secret. Tech companies use a lot of temp workers.
Sure.
Saves on various benefits. So we're seeing that sector's already contracting. It is going to be the place to be this year selectively. Some of these companies are going to be like Greenspan in 1997. He's going to say, forget about it. They're going to shoot higher. So you want to have a balanced portfolio in the sector. And I think you want to keep that in mind. Not all tech is going to zero, but a large number are.
Well, that's a bit sobering, but not necessarily. If you're playing that side of the trade, that's not a bad thing at all. And actually, about that, in Banyan Edge, our e-letter, which if you're not reading, you definitely should be. Adam, you recently wrote, you're a very modest guy. You don't like to brag about yourself, so I will actually do that for you. You mentioned that you had bet against a major name in tech, and within really just weeks, you had already taken a profit of about 69% on 1/3 of that position, but you still have the remaining 2/3 of that trade on. You're still letting that rip. What was the story with that? What can you tell us?
Yeah, I mean, it was a sentiment story. Basically, there were a lot of names that ran up in the recovery from COVID in 2021 that just basically ran up on pure momentum and pure sentiment. And I'm certainly a momentum guy, but I realized that at the end of the day, these momentum trends do run out of steam. And this was really a story stock. I don't want to talk about it just yet because we do have the trade open. But yeah, I'm expecting anywhere from 400% to 1,600% gains on this short. More stepping back, more philosophically, I found in my career a lot of retail, a lot of regular investors don't like shorting stocks. For one, it seems it goes against the long-term bullish bias of stocks. And I'm kind of an 80-20 guy. 80% of the time, I'm more than happy to make money on the long side of the market. I'm a cautious optimist. I do know that bull markets or, stocks tend to be in bull markets longer and for greater gains than in shorts. But you do have to look for these points of asymmetry where the market is all leaning to one side and there's kind of an asymmetry. Earlier this year in one of my option trading services, I saw that small cap stocks basically made a bullish breakout in late 2021 from this big long sideways pattern. But then the bullish breakout lasted like a couple of weeks, and then it came right back down into the pattern and made a bearish break down from the bottom of that channel. And so that to me was a sign that the bull market was ending and that small cap stocks were going to take it on the chin initially. So we made a couple bets against small cap stocks. We also made a bet against Spanish stocks during the energy crisis in the spring and summer of 2022. So there are ways to make, and the other thing to realize is you don't have to short shares of stock. I mean, that is one of the riskier and more costly ways to bet against stocks. But Mike kind of mentioned earlier that buying put options is a risk limited way to do it with unlimited potential. But ultimately, I think that there's a role for short selling in the market. I mean, you don't want a one-sided market where you can only buy. I mean, you want price discovery, you want buyers and sellers and to determine a fair price. I remember at the end of 2021, I was listening to a podcast. It was on crypto. And this is nothing against crypto generally. It's just obviously gone through a bear market in winter right now. But yeah, at the end of 2021, everybody thought it was like a one-way market. And I remember like Nick Carter, the guy that was a big proponent, founder of Coinmetrics, I believe. He was talking on a podcast about how folks were trying to get a short Bitcoin ETF. And he kind of laughed. He was like, I don't know why anybody would want to short Bitcoin. And I was like, well, I mean, anybody that thinks that a market is a one-way trade is kind of delusional. I mean, you want people on both sides of the print. So ultimately, I think that this is going to be 2023 is going to be an environment where short selling can be very effective. That said, you don't need to go out and short everything with high leverage. I mean, we are going to have a bear market bottom here at some point, and things are going to rip higher, especially the low quality stuff. So I'm being very selective in this market.
You know, I remember your trade on Spain. I remember when you put that trade on, and I remember nobody else was really talking about that. Like you were really, that was an opportunity you found that nobody was really talking about at the time, and that really stuck with me. Anyway, you know, Ian, I know we think of you as more of the macro, big picture, bullish growth guy. But I know that you're more opportunistic than that. I know you too have made money on the short side, and I believe you kind of cut your teeth in the last financial crisis on the short side.
Thanks for bringing that up. So, to Mike's point, and also Adam was talking about this, the timing of shorting is very difficult, and that's why a lot of people don't engage in it. And I can, recall from my experience, I put a big bet on in late 2006, early 2007 that we were going to have a financial crisis, primarily because, I used to work on the institutional trading credit desks at Citigroup and Solomon Brothers before that. And I knew that a lot of the products that we were underwriting back then, were held up by I would say the kind of risk that people were taking was a lot more than the reward they were getting for it. And it just seemed at the time that banks were really over-levered to the housing market. But I can tell you from experience is that I was wrong. I got my head handed to me for about a year before things turned the right direction. So getting the timing right is very difficult. And I think another reason why people don't short as often is because, as Adam said, the markets generally tend to go up over a long period of times. But you do have these very short, sharp corrections in bear territory, which can lead to huge drawdowns on your portfolio or amazing trades if you're on the short side. The one thing that I think has been missing from this bear market as compared to the other ones that I've seen is that the VIX has been relatively subdued. If you go back to the COVID crisis, we had the VIX jump up to the 80s. In 2015, when we had the sort of fracking shakeout, the VIX was in the taper tantrum, the VIX was above 50. I can even show you this chart if you want to share it to viewers. 2009 or the financial crisis, the VIX got up close to 100. Even going back to 2000, during the dot-com bubble blow up, you had multiple times when the VIX crossed over 40. Another one was during 9/11. This time, we've gotten to the mid 30s. So like the last year has kind of been more of an orderly sell-off than anything. I know there's some structural reasons where people say, well, there's a lot more short dated option contracts and it's muting a lot of the volatility that you typically would see in the VIX. But, I tend to think that we're going to have, like Mike says, some type of big, sharp shakeout at some point this year, which is going to lead to an amazing opportunity for traders, but also give us a nice reset for a longer sustained rally over the next decade.
Yeah, they say that this time is different. It very rarely is. If the volatility has been kind of absent, apart from really about a year ago, it spiked. But you're right, over 2022. We really did not see volatility in line with the declines, which is unusual.
Yeah. And also we had a number of, heavily down days where we were down 3 to 5% in the market, but the fear, of an unknown event just wasn't there like you would normally see in brutal bear markets. I mean, maybe it'll start to pick up as we get into the earnings seasons and companies are less transparent on how the year is going to go because of the impending economic recession. But so far we haven't really seen it. And I think a lot of people have faith in the Fed that whatever happens to the market, the Fed put option is still on the table. So we need to have like a belief that that is not going to be the case before we see a tradable bottom, I think, in the market.
Yeah, the Greenspan put. Oh, go ahead, Adam.
I just think it's a keen observation that we didn't see VIX do anything in 2022, and bear markets and pullbacks and periods of weak price action. They have different characters. You can have a sideways, where basically time does the damage rather than price. You can have a smooth and orderly pullback, which is basically what it's been in 2022. I think that heading into 2022. Everybody was talking in 2021 about the valuations and how they'd just gone crazy. And I think institutional investors actually got ahead of that and realized that there was going to be compressions in the valuation multiples, and kind of got light heading into 2022. And that's why we've seen, pullbacks, but it's been rather orderly. We haven't really seen what I call a capitulation, or excuse my colorful language, but like a puke your brains out type of move, like you saw at the last 3 months of 2008. But yeah, 2008 was kind of similar. It was like a steady grind lower for the first 8, 9, 10 months of it. And then everything fell out of the bottom in the last 3 months. So, right. I've been kind of preparing for a lower for longer type of bear market. And, you really want to see that capitulation, sell everything move to know that the excesses have been washed out and the new bull market can actually begin.
Mm-hmm.
Yeah. Now, Mike, I know you have some thoughts on this, because actually, and bear with me here, I'm going to share my screen. I used to make fun of my parents for being tech ignorant, and I have effectively become my parents.
Oh, no.
3 minutes later.
You want to get your son in there to help you out, Charles?
I may. He's actually playing video games. You can probably hear him screaming from the other room. But Mike, you had this in an article you wrote in Banyan Edge last week. This shows that the NASDAQ 100 returns by year, and there are bear markets. 2022, you see a big red line there. 2008, you see another big red line there. But there's one sort of outlier on the page, and you know where I'm looking at. It's right dead center. What are your thoughts on that?
Well, before this, I want to go back to a point that Ian made here about the VIX. And what's interesting is VIX hits a seasonal low this week. The seasonality in VIX is huge spike coming in the next few weeks. And as Adam said, tied to earnings. Yeah. Earnings season starts in earnest Thursday with some bank stocks. Friday next week, we get over 100 S&P 500 companies reporting. We have a problem potentially coming up here. Margins are out of sight. Companies are making, an average of 13 cents on every dollar of sales. That cannot continue. Long-term average closer to 8. If margins contract, earnings fall, earnings growth suffers. It's a big reason to be worried. But to the chart, we had 3 negative years, 2000 to 2002. And then 2008, we had a really bad year, but the Fed came to the rescue. The Fed did stuff that seemed impossible to believe. They just started printing money. They started cutting interest rates lower and lower. In theory, let's say 2007, we're talking about interest rates. The theoretical low is the rate of inflation plus a small premium. Return on my money. 2008, we blew through that. There was no longer a theoretical limit on the downside. And that continued until 2022. The market peaked in 2022 at the time the Fed announced they were going to stop shoveling money into the economy. So the end of QE announcement, kind of a mini taper tantrum that has been now, I know we think of a tantrum as short lasting. You guys have young kids. Some tantrums never end.
Some days.
Depends how you address it, though. It depends how you deal with it.
Yeah, that's where we are now. We are in the middle of a tantrum that's just not ready to end. Mm-hmm. And the average market falls 38.5% in a recession. Tech stocks being the hardest hit, consumer discretionary being the second hardest hit. Recently, a couple of years ago, the NASDAQ made an interesting choice. They lowered the amount of money a company has to pay to trade there. So they lowered the listing fees, they lowered the exchange fees, and companies like Pepsi moved over there. So it's not just tech anymore on the NASDAQ 100. Starbucks is a NASDAQ 100. Argue it's a tech company because of their app. It's consumer discretionary. They make extremely expensive cups of coffee that we buy, but are we really going to continue to pay $7 for whatever they call it, a frap or whatever, if there's a recession?
Yes, I think the three of us are in agreement that the answer is yes.
Yeah, I mean, we might not be watching Disney Plus, but I still will be drinking my Starbucks.
At least in the fall when they have the pumpkin spice latte.
Exactly.
That is my one guilty little pleasure that I wait for all year.
Yeah, and they're very good. Then they get the sugar cookie and the gingerbread cookies for Christmas. Pretty soon we'll have some Easter flavors rolling out. So, some Valentine's surprise. Like, Mike, Starbucks cups of coffee are very sticky. There's not much substitutes to it, and they got everyone roped in with the app. It just makes it so simple. So, that would be one thing I think that could do better than a recession than people estimate.
So pick a better example, Mike. So Starbucks is off limits.
I personally love the tough talk I'm hearing here from Ian, who has young children at home, and I'll give up Disney Plus. No, you won't.
I knew I was being facetious on there. Of course, that's not going to go. But yeah,
you might give up bread and water before you give up Disney Plus.
Yeah.
No, I think that you may see a shift towards the local coffee shops, which generally have lower priced and better quality, but that's another issue. I know at the office there, I always see those cups of Starbucks on desks, and there's some pretty good coffee shops closer than Starbucks.
I agree.
Yeah. So in 2000, we didn't have the Fed printing money. We didn't have 0% interest rates. That's a huge difference. From 1982 to 2022, interest rates fell.
Mm-hmm.
If we go back and look in time, we generally see about a 35 to 40-year cycle in interest rates. They rise for 35, 40 years, they fall for 40 years. That just ended. We are now potentially going to see interest rates rise for the rest of my lifetime.
We may all be dead by the time they start falling again.
Yeah, you guys are a little younger, so you may see another interest rate down move, but you're going to be in your rocking chair watching Disney Plus without any kids in the room at that time. So
this is a great point, Mike, because I tend to agree the fact that we've had this benefit of declining interest rates, and that's helped our economy. And a lot of that was spurred on by globalization, right? China opened up to the world in the late 70s, early 80s. You had the Soviet Union crumbled, and then you had more markets open up in Western Europe. And a lot of this benefited the idea that you could produce things for cheaper outside of the United States, and it shipped a lot of jobs offshore, including other treaties we made in the US, like NAFTA, where we sent a lot of production down to Mexico. I do see a reverse of that coming, in the sense that we're trying to shore up our supply chains, bring companies and manufacturing back to the United States. And so because of that, it's probably going to put a higher price on goods that we produce, because we're no longer producing them in countries where you can pay somebody in a Chinese factory a couple dollars an hour, whereas opposed in the United States with stronger unions and higher wages, it's different. And so structurally, it means that we probably are going to be in a situation where we're paying more for the price of goods. There's also another angle to this, where bringing all this production back is going to increase automation, increase robotics. And we have, I think at the time, the ability to employ technology to do a lot more with less. And so there are two competing ideas here, where I think in the short term, there's going to be higher interest rates because people are going to be worried about the structural problems of inflation, paying more people, paying higher wages. That also is a benefit to the U.S. economy. You're going to be paying people more wages, and they'll be able to buy more things with it.
It is.
But then also,
But in our trading window here,
mm-hmm.
you're talking about something that could be years in the future, and will be like that. That's happening. but it's also years in the future.
Well, I think this is going to be the biggest trade of the decade. This is the biggest trend of the decade, is the fact that production is moving away from these lower cost countries coming back to the United States. The most important thing to consider is really how much productivity grows on an annual basis. So, for the last, since the Industrial Revolution, we've seen 2% productivity growth. That's been the trend. We've seen a little bit more of an acceleration of it because of the information age. And I think with robotics and the idea that, you can produce a factory with 3 workers and have, like, you've already seen these Amazon factories, the robots are just doing all the work. That's going to get increasingly, more popular, not just in tech companies like Amazon, but all throughout manufacturing. And then also the impact of artificial intelligence on the media world, and specifically what we do in content producers, being able to produce a lot more with less. So I think that's going to be another thing.
I have one caveat to that. I have one very big caveat to that. Total factor productivity was inching up forever, and then it flatlined at the exact year the iPhone came out.
Yeah, I know, because people spend half their day on Facebook, TikTok. We all know that it's, I think, something like 6 hours a day, the average American on their phone. So, but if you look at like what's happening in tech, like, I think, by the way, I think Elon Musk is like showing the way how you can produce more with less. I mean, he fired like 70% of the engineers at Twitter, and this thing still works. If anything, it's gotten faster. So I think that is, it kind of leads to like what the rest of tech is going to do, where like Amazon has doubled their jobs since 2019, the amount of people working for them. They've made cutbacks already. Facebook, labor has grown to 50% more people.
Ian, actually hold that thought. I want to come back to that. That's good. You wrote about that last week, and I want to cover that. But before we do that, Mike, let's go back to you real quick. You were talking about, we mentioned things are different now, but we went back 2000, 2002. We saw something very unusual, not what we're used to. We're used to seeing a bear market, then the next year things rebound. You have a bad year followed by a big recovery. That didn't materialize in the last big tech crash, 2000, 2002. Now you're kind of suggesting that something along those lines is likely going forward. Why don't you kind of flesh that out a little bit more?
Well, the big thing is the same points Ian's been hitting is you're going to have a shakeout. Basically, you had 2,000 companies listed in the last 5 years. Coincidentally, you had 2,000 companies listed in the last 5 years before 2000. So, I know that's just a coincidence, but you had too many companies come to market with basically into late 1990s. If you added .com to your name, a venture capitalist would give you money and you could then become a company. A lot of dumb ideas got funded, and there were a lot of dumb ideas to shake out. Same thing has happened in the last few years. A lot of SPACs just aren't making it. There's going to be a shakeout. They're going to drag down other companies with it. When FTX collapsed, it turned out there was this intricate web of companies that were going to go with it. We're going to see the same thing here. We're going to see robots in McDonald's. But there's a lot of companies trying to be that robot maker, and there's only going to be one leader in the end. So, they're going to carry that company to new highs, and all the competition is going to go to the wayside. That's the kind of thing.
Mike, that's a really good point. You think like, who's the leader in search today? Well, it's Google, fine. But go back to the early 2000s. There were like 6 different search engines that people regularly used. And I would struggle to even remember their names today. I remember Yahoo was around. There's one called Alta Vista or something.
Alta Vista, Lycos, InfoSeek. You don't remember these? Go.com.
You have a better memory than I do. And so
spent a lot of time on search engines, I guess.
Well, but so did I. But what happens is, they all fall by the wayside. We're left with Google won the race there, and I guess you have other ones being or whatever, but it's really just Google, right? Because all these others were shaken out. So before I go any further, I do want to announce something. So Mike, you're putting on a presentation on Thursday, and this is really a big deal because I've read the notes beforehand. I know what you're going to talk about, and I also know that I plan to attend. So anybody watching this, please follow this link below. This is something you really do want to hear. Mike is going to lay out this shakeout hypothesis here. And more importantly, he's going to show you how you actually profit from it, how you turn this shakeout into one of the very best opportunities of potentially the next several years. So this is a big deal. You really don't want to miss this. Now, Ian, going back to you, you wrote this piece last week, and I actually took notes on this. I actually wrote this stuff down because I don't have as good of a memory as you. I actually had to write this stuff down. You wrote, and I quote, employers are cutting back hiring. Facebook laid off 11,000 workers. Apple laid off 100 recruiters and froze hiring. That was interesting to me, because companies always, they hire too many people here, they need to hire more there. They're always shuffling, and you grow too fast, you have to cut back. That's normal. But Apple was actually firing the recruiters. They were firing the people that look for workers. They weren't just firing workers, they were firing the people that hire workers. So that suggests that this may be rough for a while.
Yeah, maybe they did a bad job hiring people.
maybe that's just it. Like you hire too many people. This is it. You're done, brother. But I found that to be particularly sobering. It's not only are you laying off a huge number of people, you're laying off the people that hire people, which suggests that this is not turning around.
Yeah, so what we can take that for that is those companies probably have more visibility into their earnings over the next couple of quarters. They realize that profits aren't going to be, what they previously expected, and they need to improve margins. The easiest way to do that is you reduce headcount. The other thing I would note to that is that, I think for the last 10 years, we've been thinking about artificial intelligence and the impact it's going to have on blue collar jobs. So the idea would be that we create this semi-autonomous or fully autonomous truck, and we don't need 3 million truckers overnight, right? The irony is that one of the quickest kind of low-hanging fruit problems that the new AI that's come out solves is computer programming. So like, I don't know any coding language at all. I mean, I speak Russian better than I speak like Java or anything like that. And I don't speak Russian at all, but you can go on ChatGPT and it can write the entire program app for you. And I was listening to this developer who was talking about how it used to take him like 2 days to convert an application from one programming language to another. Now it just takes a couple clicks. So I think what you're going to see is,
and that's only going to get better, by the way.
That's only going to get better, but then it's going to allow existing engineers, the good ones, developers, to do more with less, to not need huge teams of engineers anymore, which a lot of it has been outsourced. Like if you have a business, instead of hiring all your engineers in the United States, you outsource a lot of work to India and other places where they've got great programmers, but you can pay them a lot less. Now it's like you can just let OpenAI do it. So I think that that is all part of like the tech shakeout, which is going to make these companies become a lot more lean and mean, I think, over the next couple of years too. I mean, not I think this is going to be a trend that continues.
It's kind of part of that story of shakeout.
Mm-hmm.
Now, speaking of that, now, Adam, one can be a fan of football teams or rock bands, and one can also be a fan of stock rating systems. I don't know that I was the first user of your stock power rating system, but I was definitely there at the beginning, and I've used it pretty well religiously ever since. Love the thing. You have this systematic way of rating every stock in our universe by the factors that you have proven actually matter. And so you can break this down by sector. You can slice it and dice it in a number of ways. Kind of looking at your data, what have you seen? What is your rating system shown as going on in tech world right now?
Yeah, it's interesting because I developed this rating system well before COVID, and I was able to see how a lot of the big tech growth tech names did really, rated well in 2021 and kind of foresaw some of the rallies there. But it's been interesting to see the sea change happen. And this is really why I feel like our audience needs to follow someone like myself and Ian and Mike Carr, and please come to Mike Carr's presentation because really the devil is in the details. And everybody kind of has a sense that tech got ahead of itself, but tech is not one monolithic sector where everything is the same. Some tech is purely a social platform and uses ad revenue. Some tech actually manufactures things. Some tech helps industrial production be more efficient. So tech is not one homogenous thing. If you look at what
I'm
happened
so
in
glad you brought
2020,
that up, by the way.
yeah, I mean, everybody just says tech,
Yeah,
and it's like
so
it's one thing,
different than
and
it was 20 years ago when it just said
yeah,
tech, that was just semiconductors and PCs. Yeah.
exactly. And like if you look at 2022, I mean, you saw a lot of the kind of whiffs of the dot-com era, companies that were consumer discretionary stocks like Carvana is basically an online, is basically a used car lot, but they claim to be a technology company. WeWork claimed to be a technology company, but they were just a real estate and leasing company. A firm claims to
Subleasing,
be,
by the way, not even a real leasing company, a subleasing
Exactly.
company.
Overpriced leasing company, by the way. I don't know if you ever
Exactly.
tried to look at an office at a WeWork.
Yeah. So some of those excesses have already been washed out, 80 to 90% losses in the past year or so. But then the other side of tech, I mean, big tech, very, very profitable companies, the most valuable companies of the last decade, Apple, Amazon, Google, Microsoft, Netflix, Tesla more recently. I mean, those are also companies that I don't believe are going to get completely destroyed and go by the wayside by the way of dinosaurs or the dodo bird, but they are. The other thing you have to look at is the price you're paying for their future earnings. Okay, so my 6-factor rating model looks at momentum, size, volatility, value, quality, and growth. And the interesting thing about the technology sector, like if you take out all the individual stocks out of XLK, the Spider Technology Sector ETF, it actually rates number 1 on growth because a lot of that is backward looking. So they have definitely the market leading growth and quality as far as their profit margins and their cash on the books versus debt. But if you look at the valuations, XLK, the technology sector ETF, rates the worst out of every single sector on valuation metrics, whether it be price to earnings, price to book, price to cash flow. So really you have to ask yourself, yes, I want a stake in Google's earnings ahead, but what multiple am I willing to pay for that stake? Or is there a better opportunity elsewhere to get? I mean, $1 of earnings is $1 of earnings. It just, a lot of it matters whether is it durable. You can expect the sustainability of those earnings, that $1 of earnings, but 2, what's the price you're paying for it? So that's really why I say the devil's in the details. You don't just want to go out and short everything tech or that it seems to be tech. But if you watch Mike's presentation, he's going to show you what pockets of tech and actually how to play it, specifically.
Yeah, no, that is a very, very good point. This year has not been off to necessarily a rough start. 2022 was rough, but 2023 thus far has been kind of a mixed bag. It kind of brings up the topic of the trader language is always so colorful, the dead cat bounce. And Mike, I know you.
This is not PC, by the way.
This is not PC at all. Please do not let the SPCA
and
or
nobody try
know
this
about this.
home.
Please, nobody try this at home. I'm doing this in Peru. That would even be frowned here, where things are a bit more libertine. But anyway, Mike, tell us a little bit about the dead cat bounce. Like, what is that? Are we experiencing one now? Like what's the story with that?
So I learned about that term from an old floor trader who was retired by the time I met him, and he couldn't even spell PC. So this is like the tamest story I could share with you about him. He would love talking about the dead cat bounce. And he still had an office down near the exchange, and he would look over across the street at an old building there and say, if you go up to the top roof there and you throw a dead cat off the roof, when it hits the ground, it's going to bounce. Still going to be dead, so it's going to fall again. And that's the trade. You're looking for the stock is dead, basically. And you throw it off the roof, it hits the ground, it bounces. It's going to go lower. You want to take that shakeout trade when it's in that bounce phase and catch it for the next leg down. And that's the whole challenge, but you're just looking for the dead cat part of it.
And it's important to understand.
We're looking to catch that cat in midair.
Yeah. But it's important to understand the mechanics of like why that happens and why it's almost so obvious that a lot of these like heavily beaten stocks have these incredible bounces. I mean, Mike, or Adam, you can probably explain like the whole idea of, the 20% of the float being short, and all of a sudden it goes in the other direction, and you get like a short-term short squeeze. But the reality of the stock hasn't necessarily changed. It's just the sentiment and the how easy it is to go borrow the stock has changed. So there can be a lot of technical aspects to the move in the stock that are very violent, more so than anything changes with the company.
Yeah, a lot of it's inside baseball, but a lot of it's flows. I mean, you have short sellers who got in early that maybe want to book a 50 or 100% gain, and they start buying back shares of stock kind of all at the same time, and that will put a bid under stocks. And then if that move goes on long enough, the short sellers who kind of got in late at the bottom, they're suddenly a little more leveraged, and they're looking at losses. So they're buying to cover on a short, tight stop, and that can make that bounce go further. But yeah, the idea is that on the fundamentals, the stock price is either a zero or much lower than it ought to be. And we talked at the opening of this talk about how the timing of getting into shorts is so important, because stock prices tend to fall more quickly than they climb, and if you don't catch those moves quickly enough, then you've missed it. So again, that's really why you want to follow somebody like Mike, who has the detailed expertise on which stocks are most likely to fall, and the exact timing and the vehicle on how to play them. I mean, shorting stock can be risky if you do it the wrong way. It can be very risk limited if you do it the right way. So there's different ways to do it.
Yeah, and about that, I would say, again, if you haven't gotten the link yet, I'm going to put the link down here. You really do want to join us for Mike's presentation on Thursday. I'll be there watching. This is really one of the most, this is, of all the things I've been looking forward to, starting this year, I really think this is it. Like, this is something I think is really going to be a fantastic opportunity in what could be a really difficult market otherwise. So moving on. Let's move on to the next section here. This is also where the hilarity begins. So I mentioned that I have become my parents when it comes to tech. We actually put out a poll last week to our readers that said, are you bullish or bearish on, drumroll, Tesla? This is where it gets fun. We didn't actually give them the option to write bullish or bearish on the poll. It came out as yes or no. So are you bullish or bearish on Tesla? Yes or no. So we interpreted that as yes being bullish, no being bearish. That may be wrong. If I have misrepresented anyone's views, I will buy you a drink next time we have an in-person event. But let me share my screen again. Where are you? Here you are.
What are they drinking in Peru? Pisco sours? Is that the
Pisco sour is a good cocktail, but if we are passing those around, I do recommend you stop at one, because if you have two, you may struggle to get home. But anyway, if we interpreted the data in the poll right, we see that a lot of people are still quite bullish on Tesla, about 70%, in fact. So let's have some fun with this, guys. Let's stop share. There we go. We're going to do this Roman Emperor style. You're going to go around the room and you're going to say thumbs up or thumbs down. So Mike, let's start with you.
Okay. Do I give a reason or just a thumb?
Oh, no, give us a reason. For first, dramatic.
We just want to see your thumb, Mike.
Yeah, you can be cryptic if you want. You can just, you can just give us the thumb and then tell us to leave. But yes, we would welcome commentary.
Okay, I want to go way back again, and I can't see if my thumb's on screen yet, but I want to go.
By the way, Mike was an 80s hand model. Did you guys know that?
So I want to go back to the early 1900s, and there were an awful lot of car companies, about 300 that were formed. And by the 1950s, there were 3. So, the survivors are difficult to find in this sector. Tesla is an early leader in electric cars. Chevy Bolt costs about $26,000 and is now becoming available. Tesla makes a great car. There are pros and cons in that price point to the Tesla relative to now the BMW, the Mercedes, all the other brands. Lexus, I saw, just came out with a nice commercial, so I assume they have a nice electric car too. you no longer have to buy Tesla. Back in the early 1900s, if you wanted a Ford, it was a black Model T, because that's what Henry Ford said you were going to get.
Well, no, Henry Ford's exact quote was, "You can get it in any color you want, so long as it's black."
Tesla is similar, lots of limited options there, whereas BMW lets you build it from the frame up, basically. And maybe even a little bit safer. Tesla has those door handles that cannot be opened in an emergency. I'm probably the only naysayer on Tesla in the call, but as far as the car goes, there's competition now, and I don't think Tesla's up to the competition. And I'm going to get a ton of emails on this, but come on, if you're paying $70,000 for a car, there's options now. If you're paying $100,000, there's a lot better options right now. So I know Teslas can survive a 250-foot drop off a cliff. We proved that last week.
By the way, this is not a dead cat bounce. This is a dead Tesla bounce. I don't know
There's
what
going to
this
be a
is.
lot of dead cat bounces here in Tesla because people, 70% think it's bullish in the long run. And they're diehard believers in Tesla. And Tesla has a lot of individual ownership. So you're going to have a lot of dead cat bounces here, but the institutions have been shying away from Tesla a little bit more and more all the time.
There was a Tesla that fell off a cliff last week, and it did not bounce, and everybody actually survived. So from a safety perspective,
walked
like, you
away.
couldn't ask for a better
Amazing.
outcome. Yeah.
Well,
I
Ian,
don't saw the
it's your
car.
turn. Ian, are you thumbs up or you thumbs down here? Let's see that fist.
I'm gonna give it a very weak thumbs up, and the reason I say that is because I think that my time frame and Mike's time frame is arguably different. I think that
Sure.
Probably the Elon has brought. So I'll take this step back. Like, the worst mistake that Elon made was buying Twitter. Number one, he is weighing into way too much political controversy. That's bad for his brand. He's the entire Tesla brand. They do no advertising. Other car companies spend $5 to $10 billion a year advertising their cars. Tesla does zero. So I think that was a misstep on Elon's part. There's also a worry that he's focusing too much on Twitter and not focusing on delivering the best car. So that, I think, is a short-term negative for the stock. Obviously, there's some technical issues happening in the stock as it continues to break down to lower lows. The positives, I would say, the upside here is, I think, as an asymmetric bet, you probably have 50% downside, worst case scenario in the stock, going back to around where the stock was in 2019 before COVID. But I think the upside in this, and to Mike's point, yes, Chevy does have a $28,000 car, but Tesla has one of the reasons why they're in the lead in the EV race is they've already developed all their contracts with their suppliers that other car companies have. So they're going to scale in a lot easier fashion as we move into the EV age than other companies. They've got a huge head start on the fields. They've got better battery technology. And I do think within the next year, you're going to see them release either a Model 2 or a downsized Model 3 that comes at a $25,000 price point. Because let's face it, you cannot mass produce and have everybody drive Tesla cars if they're $45,000, $50,000. That's not the price point. That
not everybody drives a Mercedes-Benz today, so that's not changing tomorrow, right?
Even like, okay, so like a BMW 3 Series is probably going to cost you around $50,000. Yeah, exactly. So the other thing is that I think that the real race is not the EV race. The real race is for full autonomy. And this is a really difficult problem to solve because it's easy to go from 80% to 99% efficient, believe it or not, even though that sounds like a huge jump. The problem is going from 99% to 100%, because within that 1%, there's the long tail of seemingly improbable outcomes that could possibly happen when you're operating a fully autonomous vehicle. And I talked to Amber about this earlier. It could be like a hawk flies in the road to eat some carrion in front of you. Like, it's not a situation you deal with the other day. Or, maybe somebody shoots a bullet at you, right? Like, those are things that happen in very small probabilities in the real world, but they do happen. And the cars have not seen enough of these events to prevent all of them. So there's going to be,
you know what else they haven't seen? They haven't seen traffic in Lima's Javier Prado Avenue. The joke around here is like,
right,
like Tesla, like a Tesla would like its brain would explode if it tried to.
Yeah, you got like a
here.
scooter right in front of you. There's some guy who's got like pigs on the back of his scooter and they're falling out in the road in front of you. I know exactly what you're talking about. So that's going to be the hard thing. But I think Tesla is able to solve that first, just because they have more real world miles than any other car company. And so I think that is the market start to see some more clarity on that. And Elon's been talking about this for so long, you know, he's like overpromised, under delivered, but it is going to become a reality at some point. And even if it's not till 2025, investors will buy the stock in anticipation of it, because it means that every car you own, which is sitting in the driveway, you know, 99% of its life not doing anything, now becomes something that you can automate and earn money from. So the car automatically becomes more valuable. And I think that's sort of the, you know, the best case scenario for Tesla, which makes the stock go back to it and through its old highs as it becomes, you know, taking over the entire $3 trillion or $4 trillion transportation market by the end of the decade. So that is like the super bull case for Tesla. But I do think that in the short term here, you could see some more downside, just because of, you know, the economy is going to recession, and then no one, and what Elon is doing with Twitter is not good for his brand. And, you know, and also he has to sell more stock every time it goes lower to meet a margin call, which is continuing to put more pressure on the stock. So,
and traders know that he's selling, and nobody wants to be buying if he's selling. So that's structurally an issue for the stock.
Exactly.
So.
And I know, I'll give props to Adam because I know he's got a great trade on this. So I'll let him tell us what he thinks, bull or bear, on Tesla, and whether or not he's going to keep holding on to his short.
All right. Well, with that, I'll give my thumb. It is a big thumbs down for right now. So I will qualify that by saying time frame. I think it's important for our viewers to know that we may have similar views or different views, but the time frame is important. So I'll say that in 2023, for me, Tesla is a big thumbs down. Beyond 2023, it's a big question mark, because I do see a lot of the long-term potential. But to me, like, so in the summer of 2022, we were clearly in a bear market at that point. A lot of the tech names, you know, the crappier ones were falling hard. And I ran a scan of each of the stocks in the NASDAQ 100 index. And I basically asked the question, what percentage drop would each of these stocks suffer if they fell from their current price to their March 2020 lows? Okay, so let's just assume, a thought experiment, that everything, all of the gains that stocks made from the March 2020 lows through the top in 2021 at the very end of the year was all just, you know, hot air, and it was all going to evaporate. Which stocks stood to lose the most? And at the very top of that screen, the stock that stood to lose the most was Tesla. Okay. Now, it may seem a little bit extreme to think that stocks are going to fall all the way to the March 2020 lows, but Amazon, Netflix, Meta Platforms, formerly Facebook, they've already done that. Apple and Tesla have not yet. So you look at Tesla. I remember Cliff Asmus of AQR wrote a note during the dot-com bubble, and he said that everybody's talking about how tech stocks are now cheap because they've fallen 30 or 40 or 50%. Well, that's not how you measure whether something is cheap or not. All it means is that they're less expensive than they were potentially. And so if you look at Tesla's valuation, first of all, it rates very poorly on my rating model. There are basically 87% of all stocks out there are better value than Tesla right now. But in the summer, when I started recommending this Tesla short, the market cap of Tesla is like greater than the combined market cap of the top 5 global automakers. And those top 5 global automakers produce like between 90 and 95% of all cars out there. So it's kind of like the sniff test, right? You know, why is Tesla worth so many more multiples of its earnings relative to all the other car companies? And part of this goes back to what we've kind of talked about, is that this idea that if you call yourself a tech company, then you automatically earn or deserve or are owed a larger price to earnings multiple. And that also comes back to something that Ian just said as far as autonomous vehicles. I think a lot of the bull case for Tesla over the long run is that they'll figure out autonomous driving and more or less become a de facto technology company or a software company rather than just a regular car manufacturer. And if you take the other side of that trade, was what if they never figure out that last mile, that last 1 or 2% they never quite figure out? Or what if another company does it and sells their software to Ford and GM and Toyota and Honda? So really, I think that to me, it's a sniff test. I also started seeing after the summer things that were supposed to be bullish for Tesla stock, like they split their stock 3-to-1 so that more retail investors could buy the stock at a lower per share price. The stock fell after that. When the Twitter stuff was finally resolved, the stock fell after that. And there is this issue of Elon Musk being like a leveraged forced seller at this point. So for me, it's a sentiment trade. Basically, the fanatical story that put Tesla into these valuation ranges throughout 2020 and 2021, I think is going to be repriced in 2023. I don't think that means that the company goes away. It doesn't mean that the company isn't going to be a leader of the EV space over the next 3 to 5 years. But I think that it's a short that's ripe for the picking, and I do intend to hold it throughout the meat of 2023.
I'll weigh in on this too. This is fun. I'm gonna join the bears on this one. I actually really like Tesla. I really hope the company is successful over the long haul, but I can find no justification for the current valuation now. And I do look at Musk's just preoccupation with Twitter and running Tesla. Who's running Tesla if every waking hour for Musk is spent trying to salvage Twitter? So I think there will come a time to be a bull on Tesla. We'll see when that time comes, but I think it looks like
we're going to get a lot of friendly letters coming.
We probably will.
But that also brings to the point, like, Tesla, the stock, like the ideology is very cultish. I mean, if you look at like the top 10 holders, like Korean retail investors are like a large holder. I mean, it's like almost orthodox in Korea that if you have spare money, you invest it in Tesla because it had done so well for them. So
Ian,
out of curiosity, is that you mentioned that the other day, out of curiosity, is that permanent money or is that leveraged money? Like at what point will they sell, or are you telling me that they will never sell?
I think that like people's beliefs are hard to change, although I do also believe that like price changes sentiment just as well. So it's like, I'm struggling to think of a real world analogy, but one other factor about the $25,000 car that I also think that we're sort of overestimating is that if you have a $25,000 car, we know that like the Model S and the Model X are like the high end margins. They have huge gross margins. Are you going to spend $100,000 on a car, like a company that also sells a cheaper brand? Like at some point, motorists want to be different. They want to feel different. Like the car that you drive around is sort of your reputation. And it's like, if everybody in your neighborhood is driving like a Tesla, do you also want one too? Like you might not like the guy who's like down the block that drives a Tesla and you don't want to be that person. Although, I mean, like you could apply it to Jeeps. I feel like everyone in South Florida has a Jeep. So like, it doesn't really matter. I don't know if Tesla has that like cool brand cachet so much. If it becomes like a mass market vehicle is what I'm saying. I think
Tesla could bring out, they could make a Jeep. They could make a Tesla Jeep someday. That would actually be kind of cool.
Yeah, but there's a reason that like Mercedes-Benz doesn't sell a $20,000 car. They could, right? And like Porsche, I mean, the entry level is you have to get to a certain.
Well, it's like there's Toyota, there's Toyota, and there's Lexus. Like when they made Lexus, what is a Lexus? A Lexus is a fancy Toyota, but it has a different brand because they're going for a different clientele. So
exactly, yeah, it's Audi and Volkswagen, same thing. They're basically built on the same chassis. Yeah. Like if you buy a Volkswagen Tiguan, it's built on the same platform as the Q3 is. It's just the Q3 has like much more interior. It's got the Audi symbol on the front, so I worry that when Tesla expands to the lower end of the market, how that's going to impact their higher end brands as well.
We'll say one last thing on Musk. You probably know this, but Robert Downey Jr. of Iron Man fame, from the Marvel Comics movies, he actually based, the Tony Stark Iron Man character is obviously from the comic books, but when Downey was like looking for a real life person to imitate, kind of get the mannerisms down, the speech down, like who he modeled the character after, it was Elon Musk. So Elon Musk actually is Iron Man from the Avengers. So it kind of goes into that cult that surrounds the man and the stock. It's funny. It is sort of a unique case, but as they say, bulls make money, bears make money, pigs get slaughtered. So it should be interesting watching all this play out. But guys, let's move on to the next section here. We're going to do some Q&A. So let me start by saying to our viewers, guys, we really have a lot of value in this for us. Like we love getting your questions and comments. That really helps us a lot. We love answering. Please, we can put the address down here. Please do write in with questions. We love to answer them. So with that said, let me jump into a few that have come in over the last week. This is actually a comment, and I love this. Ronald writes, my goal for let me me preface this. Our question was, what are your goals for the year? What are your goals for 2023? And, how can we help you get there, right? So Ronald writes in to write, my goal is to be as good of a person as my dog thinks I am. Just stop and really, there is wisdom in that. Like, if we were all as good of people as our dogs think we are, we would live in a utopia. Like, we would live in a perfect world. So anyway, I got a laugh out of that.
They must love the fact we're talking about throwing dead cats off buildings, though.
We didn't mention dogs, thankfully. Well, yeah, the unsaid thing is, at least the dead cat is dead at the time it's thrown. No one's throwing a live cat. So
that's true.
It's still morbid, but at least we're not abusing a live animal. Anyway, I digress. Corey writes, I am hoping to vastly grow our stock portfolio in 2023 so that I have the potential to retire earlier than expected, along with the option for travel and possibly purchase a vacation home. That's what I like to hear, setting the bar high. And that's where we can help. Hopefully we can help get you there with some really solid ideas. Now, moving on to some actual questions. And this is a good one. And Mike, I'll let you take this one. Brian writes, in your Monday letter, you asked us to write goals. My simple one is that I am too apprehensive to take the first step for investing. I want to be confident enough that I can do that first step. So, Mike, you've been trading a long time. You've seen bull markets, you've seen bear markets, you've seen sideways markets, you've seen every kind of market there is to see. What's your advice to helping someone take that first step?
Okay, so let me start. These questions are randomly assigned. So this isn't, I have a great story, so let me take this question. But I do have a great story. I retired from the military in 2005, and I was going to be trader full-time. I had a strategy built out. I'd been trading it for 5 years, winning year every year. I had a 25-year back test. Couple of losing years, nothing significant. This is just a great strategy, diversified across futures, provides leverage, provides good income. I retired February 1st, 2005. February 3rd, 2005, this system entered its worst drawdown in history. 18 months, which was 3 times longer than expected based on historical data, much deeper than expected. I had done everything I could. I have read hundreds of books on investing. I have spoken to thousands of people about investing. I did all the prep work just right, and things didn't work out right for me. I used that time. I kept with it. I kept researching. I kept trading, and it worked out. But you're never prepared for what lies ahead. And that's true in investing in life. We're just going to react to whatever comes our way. So I understand the apprehension. The only way out of it is to take action. So if you don't want to put money at risk, paper trade. Get an account at a brokerage that allows paper trading. Take the trades on paper, see how you're doing, see if it's something you can accept. And then after just a few months, set a deadline. I'm going to do this for 2 months, 3 months, then make your decision. So that's my advice.
Yeah, and along the same line, start small. You don't have to start with huge bets. Start at paper trade and then move on to smaller little, small trades, and then just go from there. I think that's some really good advice, Mike. Moving on. Adam, I like you for this one. Let's see what Peter has to say. Peter writes, it has turned out to be a perilous time to retire. Inflation rates have been incredibly high for the past couple of years, even higher than what is officially posted in CPI numbers. Stocks and so-called risk-free bonds have lost big money. The effect in down markets of stocks and bonds, along with super high inflation, feels like it feels like getting a good hard 1-2 punch to the gut and the head. The situation reminds me of a quote from Mike Tyson. Everyone has a plan until they get punched in the face. Adam, I chose you because you have used that exact same metaphor in the past. I've actually seen you write that. So you're a systematic guy. How do you make a plan and stick to it?
Yeah, it's a great quote. It's definitely true. There's also a jazz and R&B and blues guitarist called Charlie Hunter, who has an album by that name. Everybody has a plan until they get punched in the mouth, I think. So if you're a guitar fan music, then look that one up. But I mean, the idea is you're going to get punched in the face regardless by the markets one way or another. Would you rather have a plan, or would you rather not have a plan? Peter talked about a lot of macro sea changes that happened over the past 12 months. Inflation worse than in 40 years, interest rate hikes more aggressive than in 13 years. The first time in 50 years that stocks and bonds both fell by double digits. And really, this is kind of proves a point that a lot of the strategic asset allocation strategies that require you to forecast macroeconomic variables are rife with risk. And the other side of that is if you try to take a more pragmatic, tactical, systematic strategy of making money, whether it's over a couple of days or a couple of weeks or a couple of months, and if that systematic strategy is adaptive, it basically allows you to get out of investments that aren't well suited for that particular environment and into investments that are better suited. That's really, my way of navigating these markets. And that doesn't mean it's easy. You certainly get punched in the face, in the mouth, and the gut a number of times throughout. All of your trades aren't winners. But if you have a system to fall back on, all you really have to do is know that you've trained for it. You have to kind of absorb that punch and then stay on your feet and keep moving forward. But man, if you had really no game plan or no system for trading, and you just, every round you went in the ring and took a hit and decided what to do next without any game plan, I don't know how you would survive long at all. So that for me is, it doesn't make investing super easy, but it makes it more simple and more doable, just taking a pragmatic, tactical approach.
My favorite boxer was always Tyson Fury. The guy was a big, fat guy, not athletic. This guy does not look like a world-class athlete. But that guy could take a punch. That guy could take a punch like something out of a movie. So anyway, I digress. Ian, I'm going to give you this last question. Dina writes, I am a lifetime member of Strategic Fortunes and Extreme Fortunes. My long-term financial related goals that Banyan Hill can help me achieve are retire by 62 and a half, which is a very precise year, I might add. Exactly 62 and a half, not 62 or 63. But hey, we got to have goals, better to make them precise. Purchase a waterfront vacation home and a small boat for exploring and fishing, and make a concerted effort to take some profits on the way up. It's that last part I like. So Ian, why don't you give us some general advice on it? When do you take profits? How does that work for you?
Sure. So first of all, Dina, thanks for writing in. I appreciate that you are a lifetime member of two of my services. And I like that question about what you posed, Charles, about, when do you take profits? I think that it really depends on your time frame, and also depends on what type of asset class you're trading. So if you're in something like cryptocurrencies, which, can run very quickly, I like to take at least my cost basis out of the trade if it's something that's very risky. So if you're in something you bought at 10 and it goes to 20, I like to sell 50% of it and let the rest of it run. In terms of, I don't think there is a science particularly to take profits. And I think it's really up to each individual in terms of what your risk taking is. But one insight and one advice I would say is make sure that you're diversified, whether it be, have a portfolio in your fixed income portion, have something in value stocks and growth stocks, all different types of sectors. And then take an assessment every couple of months. What has done best? Where am I over allocated? Maybe sell. If one part of your portfolio has gone up significantly, maybe it's time to take profits on that and reallocate something else. One rule of thumb I always use is that if I'm in something that's really risky and I've had a huge gain in it, I will take it out and put it in the safest thing. So if it's the riskiest things at the top of the pyramid, and let's say it was a crypto asset that went up 10x or an NFT, I will sell that and put it back into cash or some type of short-term fixed income instrument because I don't want to give back any of that profit. And then if you reallocate, sort of if you take a pyramid approach, put the things that are not as risky back in less risky things, and the things that have gone up that are less risky, you can put more into the risky stuff if that allocation has gone down. So you really want to think about diversification. There's also lots of software out there that helps you with portfolio allocation, what I think is just, as crucial as picking winners is being properly allocated. Because even Adam said, last year was one of those very rare years when you have both fixed income and stocks going on at the same time. It only happens once every 100 years. It's likely, with the new worries about structural inflation, we could see a couple more years of this going down the future. But I think in the long run, having some type of balanced 60-40 type portfolio with other room for other asset classes as well is the best way to approach the market.
Well said. Well, gentlemen, thanks for joining me today. That's going to wrap up the show for this week. I will say to everybody watching and listening, Mike Carr's event is on Thursday. I will repeat, this is something you really don't want to miss. So again, last time, the link is down below. I will be attending, and I hope you will as well. That's going to wrap it up for this week, guys. We'll see you next week.
Thanks all.